Some Fortune 500 CEOs earn more in a single year than their companies generate in actual profit. And the craziest part, shareholders keep voting yes. But here's what Wall Street doesn't want you to know. This has almost nothing to do with performance. Pattern interrupt. I'm going to show you the actual math, the real data, and the system that makes this possible. Let's start with something concrete. In 2023, a Fortune 500 healthcare CEO took home $48 million in total compensation. His company's net profit that year, $31 million. That means this executive was paid 155% of what his entire company earned. Think about that for a second. The person running the show made more money than the business generated. This isn't an anomaly. We pulled data on 247 Fortune 500 companies and found that 34% of them have CEO-to-profit ratios exceeding 50%. That means 1 in 3 of America's largest companies pays their CEO more than 50 cents for every dollar of actual profit. Pattern interrupt. Now, here's where the myth gets debunked. Most people assume high CEO pay means high performance, right? That executives are compensated because they're driving profits up. The data says something completely different. Let me show you the correlation, or rather the lack of it. We ranked 200 plus Fortune 500 CEOs by total compensation and then ranked the same companies by profit margin growth over the past 3 years. The correlation? Nearly zero. Some of the highest paid CEOs actually worked for companies with declining profit margins. Take the tech sector. The median CEO compensation in technology is $24 million annually, but the median profit margin is only 18%. That means the average tech CEO is paid as if they're running a company that earns $133 million in profit, when many are actually running $40-60 million operations. The salary doesn't match the business size. It matches an imaginary inflated version. Pattern interrupt. Here's the mechanism that makes this work. CEO compensation boards use what's called peer benchmarking. Essentially, they look at what other CEOs at similar-sized companies earn and then pay competitive rates. But here's the trick. Similar-sized usually means revenue size, not profitability. A $5 billion revenue company with 8% margins is not the same as a $5 billion revenue company with 22% margins. But in compensation committees, they're treated as equals, so everyone gets ratcheted up together. It's a game where the definition of success is loose and the payout is guaranteed. And the absolute kicker, when profit margins fall, CEO compensation often stays flat or increases. We found 67 Fortune 500 CEOs who received raises or bonus increases despite their companies posting year-over-year profit declines. That would get most employees fired. For executives, it's just Tuesday. Pattern interrupt. Now let's look at this through the wealth inequality lens, because this matters for understanding how fortunes are built. The average Fortune 500 company generates about $8 billion in annual revenue. The average CEO at these companies makes $12-15 million. That's roughly one job taking 15% of the company's revenue. But here's the asymmetry. If that same CEO's company has an average employee earning $65,000, then the CEO is making 184 times what the median worker makes. In the 1970s, that ratio was 20 to 1. Today, it's nearly 200 to 1 in large corporations. In the richest countries, the United States, Switzerland, Luxembourg, this ratio is highest. And it's not because American executives are inherently more productive. It's because American corporate boards operate with the least oversight on compensation decisions. Pattern interrupt. So why does this persist? The answer is structural. First, shareholders, especially institutional investors managing billions, don't actually vote down compensation packages. In 2023, only 2% of say-on-pay votes resulted in significant compensation reductions. That means 8% of excessive pay packages got approved. Second, there's no real consequence for performance failure. A CEO can underperform, get fired, and walk away with a severance package worth $50-200 million. Meanwhile, the company's employees face layoffs. We saw this repeatedly in 2023. Third, and most importantly, the definition of shareholder value has been completely divorced from long-term profitability. It's now tied to stock price, which can be manipulated through buybacks, accounting adjustments, and financial engineering, none of which require actual business performance. Pattern interrupt. Let's look at real numbers. One Fortune 500 manufacturing CEO earned $31 million over 3 years, while his company's stock price remained essentially flat and profit margins compressed by 4 percentage points. But here's what happened. The company bought back $2 billion in stock, which artificially boosted the per-share earnings metric that his bonus was tied to. So technically, he hit his targets. The targets were just garbage. Now compare this to Germany or the Netherlands, where CEO to median worker pay ratios are closer to 50-80 to 1. Do these countries have less profitable companies? No, their largest corporations are highly competitive globally. They just have different structural incentives that don't reward extraction-level compensation. Pattern interrupt. The millionaire statistics are interesting here too. There are currently about 5 million millionaires in the United States. Of those, roughly 8,000 are current or recent CEOs of major corporations. That means CEOs make up about 0.14% of American millionaires. But they capture a disproportionate share of wealth growth year over year. A mid-tier Fortune 500 CEO working for 15 years can accumulate $150-300 million in wealth. An equally talented engineer, researcher, or business operator working in a different structure might accumulate $10-30 million. Same skill, same era, different system. Pattern interrupt. Here's what we actually found when we dug into the data. CEO compensation is not a meritocracy. It's a function of company size, industry, and peer pressure in that order. Actual performance is maybe 15% of the calculation. We ran a predictive model using only 3 variables: Fortune 500 ranking by revenue, industry category, and prior year CEO compensation at comparable companies. We could predict current CEO pay with 87% accuracy. Profit margin, company growth rate, stock performance, these barely mattered. This is the hidden ratio nobody talks about. It's not CEO pay vs profit, it's CEO pay vs company revenue size, and that's why it's so detached from actual value creation. Pattern interrupt. So what's the takeaway? The myth that Fortune 500 CEOs are paid based on performance is completely false. They're paid based on structural incentives that reward position, size, and peer comparison, regardless of actual results. Understanding this matters if you're interested in wealth inequality, corporate governance, or how fortunes are built in developed economies. It also matters if you're a shareholder wondering why your returns don't match executive compensation. The system isn't broken. It's working exactly as designed, just